Okay. Good evening, viewers. This is your tutor, CPA Cafe Charles. And today I'm going to be taking you through cost and management accounting. This is going to be an introduction to cost and management accounting. And in this video, we are going to be looking at the definition of cost accounting, the benefits of cost accounting function, the objectives of cost accounting, the factors influencing cost accounting system, features of a good costing system. Then we look at the management accounting. I've separated these two because I want you guys to take a good analysis of each item within the cost accounting and the management accounting. But at the end of the day, I'll give you the relationship between the two, and from there, we can combine those two terms and we proceed as in when they are combined. But as for now, allow me give you the management accounting as a bit separate from the cost accounting concept. So when I give you the definition of a management accounting, I'll also give you the benefits of a management accounting. Then I give you the limitations of management accounting. From there, I'll give you the relationship between the two concepts, the management and the cost accounting concepts. Having seen the relationship, we shall look at the differences between cost and management accounting and financial accounting. Then we look at the users of accounting information and the ethical requirement. And in this video, I hope to make sure I handle only the introductory part so that you get to know the concepts which are used in there. So when I reach the ethical requirements of a management accountant or cost and management accountant, then I will stop there and you shall link up when I drop another video, which will start from the cost classification and cost behaviors, because I've separated the cost classification different from the introductory part, just because from there, if I just mix it with the introductory part, you'll get a bit confused. That's why I'm like, making it a bit different. So when I'm posting another video, just know it will be starting from the cost classification and cost behaviors. So allow me kick off. As we have agreed, I'm going to be starting with the definition of cost accounting. And we said cost accounting is the branch of accounting concerned with the determination or ascertainment and allocation of costs to the products or services for decision making. When we talk about the cost accounting concept, the idea is all about how we know the total costs of production on the goods for the manufacturing firms. We want to find out how much have we spent on production of those commodities we are going to be selling. So the whole idea is about ascertainment of costs only. And that cost, you can get it as in a cost per unit, whereby you make it for one unit of item, or you can get the total cost as in a whole for the items produced. And why are we looking at this information? We want to give it to management so that they can use it for internal decision making. And that internal decision making is all about determining the profits we are supposed to get on the goods we have produced, the selling price, controlling costs and planning, all of that, as we are going to be seeing when we look at the advantages. So you can also determine a cost accounting as the branch of accounting for cost classification and analysis of expenditure, as will enable the total cost of any particular unit of production to be ascertained with reasonable degree of accuracy, and at the same time to disclose exactly how much total cost is constituted. As you know, when you are a management accountant, if you just tell the management accountant that the cost of, let's say, producing an item, let's just use an example here. If you want to say that the cost of a book is 5,000 Ugandan shillings, then the management accountant will not be contented with that information. The person wants to know, yes, if it is if the cost is 5,000, what constitutes that 5,000? Then you start breaking it into the raw materials that is included in that 5,000. What is the cost of it? Then what is the cost of labor? What is the cost of other expenses we've incurred, which are directly connected to the production? So when you just give a block figure that the cost of a book is 5,000, someone will not be contented. Maybe for these other people who don't do the analysis, but these management accountants, when you tell them that the unit cost is this, what they want to know, can you break it down? And you give the components that this portion goes to this item, and this, depending on the materials that are involved in the production of that unit of a product. That's all about. And when you try to look at how they are really concerned about this cost accounting information, is finding the total cost of an item. So that's how I can explain about that. We can go ahead and talk about the benefits of cost accounting function. When you try to find the total cost of an item, what will that help us? We said you get that information and you give it the management. Then what will that information help to different stakeholders or different people who may need that information? So we said when the cost accountant prepares that information and gives to the management accountant makes decisions for the day-to-day running of the business or the short-term operations of the business. The first benefits we say it allocates. Now we are talking about the cost accounting function. Having determined the cost, now we are trying to look at the advantages of determining the cost of a product. First one, it locates the exact causes for decrease or increase in the profit or loss of the business. When we talk about determining the increase or a decrease in the profitability of the business, here we are talking about when you try to find out the costs which are involved. Why is the business making a loss? For a business to make a loss, it means the total costs incurred in the production of the income, the total costs incurred in the period exceed the income they have received in that period. So if you try to find out the costs that you've incurred, that one will help us to know whether the company is going to be making a profit, because at the end of the day, after determining the cost you've incurred, you can just put a profit component on the costs so that you determine the selling price. So it may happen that when you've incurred more costs, and since the price most of the times is determined by market forces of demand and supply, or in the market, in the current situation, the prevailing prices in the market, you may find that you cannot increase the price just because you have incurred more costs, which makes the company to incur losses. Because at the end of the day, you may increase the price simply because you have incurred more costs, but that cost, that selling price you are incurring, it cannot be found in the real or the prevailing market situation. So from there, even if you had incurred more costs, you have to sell with the prevailing price in the market, of which will result in a loss. So when you find out the costs incurred in the production, you may either know that this investment is going to be a bit profitable, or it's going to be in a loss, whereby the costs are either high or are low. So from there, the cost accounting function helps us to identify the unprofitable products so that we can eliminate them out. Having known that on this product, if I'm to produce this product, I'll be incurring more costs, which will make me earn less profit or necessarily getting losses. Then you can eliminate that product and you produce the goods which are less, where you can incur less costs. In the end, you will be able to earn more profit. And that one is best mainly when you're doing the capital investment decision, or you're appraising the investment ventures. The other thing you can talk about, it reveals or discloses profitability and unprofitable activities. That's the same way as I explained that when you know the cost, you can know how much you're going to be getting from the profit, from the items you produced. Said it reviews or disclose profitable and unprofitable activities. Those points are a bit different with the first one. The first one was about a product, but this one is on the activity. Because you may find when you're producing, let's say, when like companies which are dealing in multiple products, you may find that, let's say for Coca-Cola, producing Minute Maid is a bit expensive than producing these other types of sodas. So for when you deliver that information to the management, they will find out how to control the costs so that they can be able to make profits. The other one is on product, but this one for the activities, you find out that some business ideas, they are not viable to the extent that even if you want to invest in some money, it is too risky for you to put in your money, whereby you'll be making losses. So you can easily identify. How can you identify that? By first knowing what are the costs incurred in the, or what are the costs which are likely to happen. We say losses or inefficiencies occur in any form. These inefficiencies, you can talk about them in terms of labor when you're managing manpower. There is a point that when you can, this manpower, it can be, let's say, if there is labor inefficiency, when the workers are not working to their expectations, like when let's say there is idle time. Idle time is where employees are paid but they produce nothing, and it can be either due to normal idle time, whereby the causes for labor not being productive is not necessarily about the employee, him or herself, is about the organization or other factors which the employee has no control about. Like if, let's say, there is a machine breakdown, the person cannot work just because there is a machine breakdown. That brings about a normal idle time. But there is also an abnormal idle time, whereby the employees, they would have been working, but just because of these avoidable causes have happened and people are not working, not necessarily that they cannot work, but since if they had taken a good precaution, or the supervisors had taken good precautions, they could be ignoring those wastages of time. Like, let's say someone is resting because the customer orders are not there. Someone is resting because raw material is not there, is not enough. So those are the things whereby someone, you can even, when you're using cost accounting, you can determine that this person has been productive depending on the number of units we produced, or depending on the number of hours someone has worked. The other benefit, you can talk about costs. Cost accounts first furnish stable data and information to the management to serve as a guide for decision making. This is very clear because when the cost accounting provides information, let's say about the cost of a product, and that information is given to the management, that's where management starts, because the management accountant cannot do anything when the cost accountant has done nothing. You have to first present what you've got as in terms of the cost, so that for them they can start from there and they start taking actions, whereby in these actions they may be taking decisions to make profits, decisions to control the costs, because after knowing that this producing this item is going to cost us this amount, someone can say that it's okay, since I've known this, let's try to eliminate some of these costs, some of the costs which can be avoided. Let's try to see how we can deal when you are reducing these costs. That's all about cost control. So we can talk about the cost accounting information is useful for price fixation purposes. In this, if you get the cost of, if you have computed the cost of the output, you can easily know that you can easily know the selling price of the items, because if you know how much you've incurred in production of a certain commodity, it will be easy for the management to set the selling price, whereby they can just apply, let's say, markup, or they can set a margin depending on which system they base on to determine their selling price. But not forgetting that the selling price is always determined by the prevailing market conditions. As you know, in economics, how prices are determined. Most of the times it's not all about the costs you've incurred, but at least that one helps us, it helps us, whereby it becomes a basis for comparison, whereby when you know the cost you've incurred in the production of a certain item, you can compare, you can set your own selling price, then you compare your company selling price with the prevailing market price. By doing so, you are trying to find out, was it very effective for the company, basing on the costs it has incurred in the production of that commodity? If, let's say, the selling price set by the company itself is, let's say, not more than what is prevailing in the market. Because at the end of the day, if you incur high costs and you want to put a profit component on it, and it results into a high selling price which is more than what prevails in the market, then you are at a risk of not making any profit, even if you are producing goods of a better quality. So when you are making the costs, that's why the cost accounting function is very, very, very crucial in the production process. So that, because the standard, the price is already there in the market. So the main objective is all about minimizing costs, so that when you set the selling price, doesn't necessarily vary abnormally from what is really existing in the market. That's how the costing information helps in the fixation of prices. The other thing we can talk about, cost accounting helps in cost control through establishing budgets and standard costs. Of course, as you know, these standard costs, those are the predetermined, you determine the price in advance. Let's say when you're doing a forecast, you can say that I'm expecting to incur, let's say, 10 million in production of a certain item. But when you go ahead and produce the item itself, you compare with the actual costs, then you will find out what is the variation. Is it high or is it lower than what we expected? And what are some of the control measures we can use to control those variances we've incurred? If, let's say, I had planned to incur 10 million, and in the actual production, I find out that I'm incurring 15 million, you'll find that variance, or that deviation of 5 million, I'll try to look into my components which made up the cost of 15 million, and I see how I can minimize some of the costs. Some of the reasons you may find that, let's say, we had planned that we are going to buy materials, let's say raw materials of 5 million. And when we reached in the market, since we had some increment in the prices because of the inflation, prices went high. So with that, it made us to incur more cost than we expected. Or we reached there in the market, but we have incurred more transport costs. Yes, the price, we said it, the price for raw materials is going to be 5 million, but we've incurred more transport costs to transport the raw materials to our place of work, which increased the total purchase price, hence making a difference. So those are some of the reasons why you may be having a deviation, and what we are trying to look at. Then the corrective action will be, if yes, we've incurred high transport costs, but the price was okay, can't we get some raw materials of the same quality, but we get them at a place which is near to our premises or where we are operating from? Those are the things which the management accountant starts to work on, and they find resolutions for those deviations in the costs between the planned and the actual. So the other thing we can talk about, the operation of a system of cost audit in the organization prevents manipulation and fraud, and assist in furnishing correct and reliable costing data. Because if you have the costing system, the costing function, if let's say, because it is also hard for these companies to set this costing function, whereby you find the companies having a cost accountant, is having a financial accountant, is having also a management accountant. It's a bit costly. So if those systems they exist, first of all, we are doing audit. We audit ourselves to the extent that what the financial accountant has provided and the cost accountant has provided, the management accountant has to review that. By reviewing that, you are removing the manipulation which could have been done by either the cost or the management or the financial accountant. You try to rectify, and you say, in this amount I've seen, let's say there are some arithmetical errors, because those ones they may happen by adding or subtracting, and you find the figures and there is a mismatch somewhere. So there is an audit. The information is audited within that process. So by doing the audit, it gives you a reliable information, whereby by the time the management accountant makes a decision, you find out that that information has been based on the rightful information. Then the other benefit of accounting function, we can talk about valuation of stock. Valuation of stock through establishment of costs by using different techniques of financial statement, various techniques for financial statements purposes. Because when we know the cost, having known the cost, because we said the cost accounting is mainly determination of cost or cost ascertainment. So what we shall use those costs we've generated to make other financial statements like the income statement, because as we said, these statements are measured in monetary values. So when we know the cost, we can easily transfer to our income statement and we'll try to find out the profit we've incurred. We can also generate our balance sheet, because when we determine the stock, part of that stock is going to be in the balance sheet as inventory or stock in our current assets. So those are some of the benefits of the accounting function. Allow me proceed to the objectives of cost accounting. I want to explain something on the objectives. When you find a question is asking about the objectives and the other question is talking about the benefits, the answers are the same, but the way you give out to them is different. But the explanation is always the same and the points, they are the same, but just rephrasing them. I found it necessary for you to give you at least these two items so that you can be able to get the difference and how to phrase them. Because I've given you few, but I know you can get as more points as you go and you search on your own. Me, I have been picking out the basic ones. So the first objective is ascertainment of cost. Cost ascertainment is cost. If someone asks what is cost ascertainment, it's just an accumulation or a summation of the costs which are incurred in the production of an item. So one of the objectives of cost accounting is cost ascertainment or ascertainment of costs, determining the cost of a product or service or any activity through cost accumulation of different cost elements. Meaning these cost elements, they are the cost component, what makes an item. Those are the components, those are the elements. So it is when we are determining the cost ascertainment is the process of determining the cost of a product or a service through cost accumulation of different cost elements, which include the material cost, the labor cost, inventory, the overhead costs. Those are some of the costs which you incur in the production. The material, labor, overheads, they are also direct expenses or other expenses which are incurred. But these are the few we can talk about. The other objective is determination of the selling price. We said that when you are determining the cost, what you want to look at is the cost, so that we can put a profit component by using either a markup or a margin, or depending on whatever scenario they use to determine their selling price, so that we can know the profit we are going to make on producing a certain product. So through the selling price of a product is influenced by, supposed to be though, this one is supposed to be though the selling price of a product is influenced by market conditions, as I said earlier, which are beyond the control of the organization. It is possible to determine the selling price within the market constraints. What this one means is that, yes, it's true, the selling price is always influenced by the market forces of demand and supply, as we said, or the conditions prevailing in the market, of which the company has no control about. Those are the factors affecting demand and supply, as mainly demand, as you know them. That for you may say, me, I'm setting up a price. Let's say I'm setting up a price which is higher than what the market is having, but you may find that people will not buy, just not because they don't want to buy, but the money is not there. The consumer income or the taxable income or the disposable income is not there. So those are there are some factors which affect the price. And most of the times, for us, our aim as an organization, we are aiming at minimizing the cost, so that when we minimize our cost, we just know when we set our own selling price, it will not, even if it differs, but it will not be of a large extent to that in the market. So that's it. The objective of cost accounting is costing, determination of selling price. The third one, we can talk about cost control and cost reduction. You are seeing we are talking about cost control and cost reduction, meaning we are aiming at reducing the costs of production. Since costs of products or service are predetermined, they always compared with the actual to monitor cost performance. To exercise cost control, broadly speaking, involves the following steps. That's when you are going to control the costs. But what we are aiming at, we are aiming at the reduction of those costs. Even if you find out that you've really did it to the minimum, someone will say, is there any other option where we can reduce it further? Are there some avoidable costs which we can avoid so that we can incur less than what you are saying is minimal? So let's look at how we can control the costs. First of all, we have to determine clearly the cost objective. The cost objective is a reason why you are doing something. If let's say you are engaged in production, what do you want to? If you are producing, let's say, soda, what are you really looking at when you try to sum up these costs you are incurring? We are trying to look at the cost. So our main point, our main issue here is about cost. So it's like let's say if you're a student and you are incurring some costs, let's say tuition, what. The reason why you are paying tuition is because you are paying tuition to pass. The main objective is to pass and score highly. But scoring highly, there are certain things which you go through for you to score highly. That's the cost objective. That one we shall look at it when we go to the cost behavior. I will explain more all the cost classification there. I'll explain more about the cost object, the cost objective, the cost per unit. Those ones I will explain more. But to give you a brief view that the cost objective is the aim. Why are you doing something? Because having known why are you doing something, like why are you studying cost accounting? I want to pass. But passing is the cost objective, but there are certain cost units and cost objects which you are supposed to incur, or there are certain things which are there which makes you to reach to that point. So we said determine clearly the cost objective, i.e., or that's to say the predetermined desired result, what you really want to achieve. The second thing is that you measure the performance. Yes, I enrolled for CPA and I'm doing a course unit of cost and management accounting, and I aimed at, let's say, getting an 80%. If you aimed at getting 80% and the final results comes and when you have 85, or if you have 75, then for us, what we are interested in, we are interested in something. What caused that deviation? If you planned to incur, if you planned to score 80%, but you goes ahead and you score 80%, what are the causes, or what made you to, what are the things you did that made you to go above what you had planned? And if you don't reach what you had planned, then what are the things that made you not to reach where you wanted to be? That's all about the cost control and cost deviation. For the student, you are aiming at scoring highly, but for the company, we are aiming at not reaching where we've set. Let's say we were expecting to incur 10 million, but our main focus is how can we produce below the 10 million? Not to the extent of making poor quality items because we want to reduce costs, but we maintain the quality and at the same time we reduce the cost. That's the main emphasis. So when you measure the performance and you find out there is a deviation, either high or low, then the second step is to investigate into the causes of the failure to perform according to the plan. Failure to perform according to the plan doesn't necessarily mean that you're supposed to be below, even if you are above. Now for the case of the organization, we always want to be below, but you may find when you have gone above what you had planned. So for the student, you can even talk about, I did more research on my own. That's why I got above what I had planned. So even the organization you may find that they have bought goods, let's say from a different supplier, and that supplier charged them a higher cost. Or the supplier may be giving those items at a low cost, but they are of low quality. When goods are of low quality, when you go in the manufacturing, they will be consuming a lot of raw materials so that to produce something of a quality. If you are incurring something at a less cost, you are buying it at a less cost, but it is costing you to the extent that you are buying more than what you would have bought. That's also a deviation. So what will be the next step is to institute corrective corrections or actions. You take actions on the deviations you've seen. If for the student and you see, I aimed at getting 70, but I got a 65, then what made you to not to get the 70 you wanted? If you see that maybe at this particular point or at this particular point in my revision, I relaxed somewhere, so next time you improve. That's the same way we deal with the costs. I hope you guys, you've got that concept of cost control and planning. Then let's proceed to the next objective of cost accounting. Ascertaining the profit of each activity. You know, this happens to, I always base to the capital budgeting decisions or the investment appraisals, because when you're appraising an investment or when you want to determine the net worth of an investment, if let's say you can be having the 2 projects and those projects you try to find out how much are they giving me as in the cash inflows every year. You can make a forecast of, let's say, 5 years time. If let's say they are giving me, if each organization is giving me this amount, as you will know from financial management that there are certain things we do, there are certain methods we use of how to determine the viability of the investment, like the payback period, the net present value, the profitability index. We can determine the IRR, the internal rate of return. So there are so many things whereby you can determine that this item is going to be providing me a very nice return on the investment. So when you determine, because when you are determining, you first of all determine the cost you are incurring. Then you compare what will be the inflows, what will be the money that will come in that, the forecasted cash flows for different periods. Then you see whether when you try to less them up and you see if they can give you a profit. So by that, when you determine the cost, you can be able to know that this activity is going to be productive and this one is not going to be productive. So we can, here they are saying the profit of any activity can be ascertained by matching costs with the revenue of that activity in order to determine the profit or loss of any activity on the objective basis. Of course, when they say the objective basis, if let's say you are choosing this investment, you know what you want to get from that investment. So from that investment, you compare what you are going to be incurring. After comparing what you are going to be incurring, you also try to project how much you are going to be getting. Then you know the net worth. The next objective is we can talk about assisting management in decision making. That one we talked about the decision making. That one we talked about. Allow me proceed to the next slide, which is about the factors influencing cost accounting system. You know, we have the cost, the company may decide to put in a cost accounting system, but there are so many factors which affect which accounting system to be installed in an organization. Some of them, we have the size of the firm. If the firm is very big, you expect the firm to be handling so many departments. You expect the company to be having so many activities to the extent that when you're bringing a costing system, it should be catering all the things which the company deals in. So the complexity of the costing system depends on the size of the firm and management requirement. A large firm has to develop a large volume of cost data regarding activities of various departments of the organization or of the firm. As I said, these firms which are big, they have so many departments which they handle, and each department is using a different software, or they are using a different system, because the system which is managing payroll cannot be, or the program that is managing payroll, you may find it is different from that which is within the production. So when you are to install a cost accounting system, you should also take into consideration what the company is dealing in. If there are so many items, you should select an accounting system which will be combining whatever the company is dealing in. That's point number one. Secondly, we can talk about the manufacturing process or methods. What are the various methods the company is using? Because you may find that the way how the organization is arranged, or the production layout of the organization is different, to the extent that some accounting systems are already rejected from the way how the organization is arranged. You may find that if, let's say, someone is having an accounting system which is a bit specific to certain items, but you find in the organization where you want to install it, that system is not, the specialization is not even there. They are mixed up with other different departments, and of which the information which comes from that department is supposed to be recorded. And so if you find that some systems cannot hold certain things, then you have to get to look for a system that can embark all the activities done within the organization. You may find that even someone can say, me, I'm bringing a system that is going to be operating, let's say to staff, depending on how they are going to be coming in and how they are going to be working. So to the extent that you find that the organization has its policies inside, whereby you may find that some employees have to go for, let's say, for a rest, but the other machine will just be computing the time, whether the person is not working or whether the person is working. So that's how you should also look at how the manufacturing process or the methods they use in the production. You may find even the production capacity for you want to install a system which can be working from Monday to let's say Monday to Friday, 24/7. But the machines you have in the organization cannot operate without getting rest, to the extent that if you want to make them work, they cannot produce the items you want, because some machines you may find when they are fixed that they can produce 10,000 kilograms a day or 10,000 tons per week, depending on the capacity of the organization. So when you are bringing the accounting system, we should also take note of what items, how the organization is internally organized, the internal control system. You should be considerate of it, whereby when you bring something, it must be of a fit to what the organization process or plant layout and other processes are working. So the other thing we can talk about is organizational structure. It must match the organizational divisions of authorities, so that individual supervisors can be accountable for costs incurred in their respective department. This is what I was talking about, that when you're organizing to have an accounting system, you should look for that system which gives the heads of different departments authority, to the extent that they are the one who's monitoring what these other juniors are doing. So if it's like, it should be giving something where the head of the department or the supervisor can reach and balance everything. If, let's say, someone is using the, let's say, purchase ledger accounts, so it should give the supervisor something like a control account, whereby the supervisor can just be checking what was posted in the control account, so that to verify what these juniors were doing when they were handling the purchase ledgers. That's how you can talk about those departments, so that by the time the head of department submits, let's say, a purchase figure or a debtor's figure, you'll find that it has been already verified in the system. So when they submit for the next department, it will be of good use and it can be of a reliable source, since it can be audited very fast. The other thing we can talk about is we can also talk about the comparison or the comparability. The system can also be able to give you a comparison of what someone did. If, let's say, you are using an accounting software, let's say QuickBooks, you should be able to access financial information of last year to compare them with these ones of previous years. So if we are installing an accounting software or system, it should be catering, it should be able to give you a comparison part whereby you can compare this one and the other one for better planning and other budgetary activities. The last point I can talk about, the other one you can search for your own. The other point I can talk about is external factors. The whole of what we've been talking about, they are within the organization, but there are also other external factors which can affect the accounting system we are using. For you may say, one of the external factors we can talk about the level of technology. You may want to install, let's say, an accounting system, but it is already outdated. Let's say we can talk about Pastel. Pastel is an accounting software. If, let's say, an organization wants to install that software, it is already outdated. When you reach in the market, it's not there. You find people are having QuickBooks, Tally, Sage, and others. So the technological factor also will affect what you are going to be installing. You cannot just say, I want to put Pastel, but when it is already outdated, where will you get the people to run that system? So the system we are installing should be cooperating with the prevailing technology, not giving something which was done, let's say 1900. There are no people even to run it. So also that one, it becomes a factor to the extent that even if you want to do it, but you will not get the people to help you do that. So that one will be a factor that will be also considered when you are installing. Allow me go to the next slide where we are going to be talking about the features of a good accounting system. These features of a good accounting system, we want to look at how a good accounting software looks like, or what are the components, what are the exits, what are the qualities of a good cost accounting system. Because at the end of the day, the reason why we are installing this accounting system, first of all, we want to do the costs appropriately to the extent that you are not making any errors. So if you bring a system, also the system matters. One of the qualities is the installation and the operating costs of the system should not exceed its value to the management. Because at the end of the day, we are minimizing costs. If what you are using to minimize cost is also expensive to the management, then how will you expect them to minimize costs? So one of the qualities of a good accounting system, since it is managing the costs to be low, we are expecting it also to be of a low cost. if it is expensive to the management, it's like some when these people, when they are doing taxation, when they are collecting taxes, there is always that quality of economy whereby you cannot collect what you cannot use more money to collect less money. You should be economical. What at least what you are spending shouldn't exceed 5% of what you are collecting. That's when you can be really doing business. That's the same thing. The cost of installation and operation, leave alone the installation, buying and putting it in the system, but also running costs. The people who are going to be operating, it shouldn't be too hard to the extent that people cannot even, it will need again more people to handle it. That's what they talk about. Then the other thing, it should be practical, must be designed to suit the business and helpful to the business. It must be practical. Why? Because there are some systems, people say, we have a system in our organization, but the system doesn't function. It is there, but it doesn't give you, it doesn't add you any value to the company. So when the accounting system is there, it should be of help. It should be giving you more versions of how you can deliver what you want to achieve. Then the other one, we can talk about the cost accounts and financial accounts should be arranged in a way that the results of a set of accounts are reconciled by means of control account. This is what I talked about, that when let's say you are designing the costing system, it should be having a verification point where someone can go and verify what he or she has been doing. Because there are some systems like QuickBooks, you can assign, the administrator can assign other junior staffs to help him or her on certain issues, let's say tax, payables, receivables, managing. He can assign you and gives you rights to those particular things. But at the end of the day, we need to be having somewhere whereby the other person can just go there to click, let's say, on and prepare a certain statement which can verify whatever you've been doing all the day. In that, it is giving you a summary of what the other people they have been doing, and they are reconciled that what they have done is exactly the right thing that should have been done. So it should be designed to that extent, whereby those control accounts, they are supposed to be used by the heads of departments, because those are the ones that determine the costs, or that make decisions, or they forward the final result to the next department, depending on the line of organization or the line of management. So the other one must be installed gradually. In this, we mean that a costing system, since it is a system, it is not a human effort. So when someone is introducing the system, it should come on a step by step. You start by introducing a bit of it. You make sure some of the staff, they have grasped the knowledge of how to operate the item, so that by the time you make it wholly, or when you introduce it in full to the entire team, they at least have somewhere to learn to go for assistance when they find some complex stuffs in there. Because if you just bring it and you throw, it gives people panic to the extent that there are some people who are just fixed. Someone has been doing a certain department and you bring in something new, is supposed to get another training for that, which will be a bit hard for certain people. So when you're introducing the system, it should be a gradual, or it should be introduced gradually or on a step by step. The other thing we can talk about, actually, when you're introducing it gradual, it's like when you're studying, like the one I'm teaching, I first do the theoretical part, so that by the time I take you through the budgetary, the master budget, I take you to the standard costing and whatever process costing, you'll be having an idea of what really covered in this, the course unit. That's how it means. Then the other one we can talk about, it should be properly documented and supported with the application user manual. The reason is, if it doesn't have a user manual, it is hard for some people to learn. So when you're designing a system, it should be having a backup, a study package whereby someone can go and read and understand how certain things are done within the system. Allow me proceed, and I'm very sure I've exhausted the cost accounting. So allow me go to the management accounting. It's not all that big. It is just small, because management accounting is just a continuation of the cost accounting, simply because the documents which are used by the management accounting, the management accountants, are prepared by the financial and the cost accountants. So it's just a continuation of the other one. So management accounting is the process of accounting concerned with the provision and use of confidential accounting information to managers within the organization to assist management in carrying out management function. And remember, we talked about this management function. Those are the selling, setting price, setting, controlling, planning, those things. We said is a branch of accounting concerned with the provision and use of confidential accounting information to managers within the organization to assist management in carrying out management function. As we said, this confidential information is already drafted by the cost accountants and the financial accountants. So this management accounting is a bit broad. It comprises of various aspects. It can be mathematically, it can be statistically, it can be financially, costing. It involves so many items, and those items are the ones the management based on to make a decision, even the tax part of it. So if someone is called a management accountant, you just know that that person is having a broad knowledge about certain aspects, because within the management accounting, the thing is very broad. It's not like the cost accounting, whereby the main point is just ascertain cost ascertainment, and for the financial accounting is production of financial reports and that sort. When those ones are done, they just forward the management so that the management, they can take action. So the other slight definition we can give, this involves the process of preparing management reports and accounts that provide accurate and timely financial and statistical information required by managers to make day-to-day and short-term decisions. Why are we saying the short-term decisions? These are supposed to be short-term decisions because these financial statements we prepare, the cost statements we prepare, they don't exceed 1 year. We always make them in 1 year. That's why the management is running those decisions within a short period of time if they base on the information we the financial accountant, the cost accountants will provide. So what are the decisions, some of the decisions they make? One of them, formulation of strategies, planning and control activities of the organization, decision-making, optimizing the use of resources and safeguarding company resources and others. There are so many because we are going to see the benefits down here. The next slide is all about the benefits of the management accounting. We have to see the limitation. From there, you will know the scope or the climax of cost and the management accounting when we look at the relationship. The first benefit, it assists management in formulation of policies and performing day-to-day activities of the business, which management has to take tactical and strategic levels through application of management accounting techniques. In these management accounting techniques, we may be having standard costing methods, budgeting and budgetary controls, those things. Those are the techniques they are talking about. The second benefit, we can talk about the assisting in performing planning and control functions effectively. Techniques like standard costing and budgetary control helps in controlling the operation of the business. As I've said, the standard costing is there. We are using the costs which are the predetermined costs we set. Then we compare with what we produced so that we get those deviations. In all, we can control the operations of the business. Okay. I hope, guys, you've got that. Allow me proceed to the next benefit of a management accounting. Another benefit of a management accounting, it facilitates coordination of activities of various departments, hence attaining the objective of the business. As we say that management accounting bases on the financial statements prepared by the financial accountant and the cost statements prepared by the cost accountant. So there is a connection whereby those two, when they provide the information, they provide it to the management and management makes a decision, of which that decision, it will again go back to those people so that they make adjustments. So there is coordination within the company, whereby when the management accountants make their reports, they give back to either the cost accountant where they got the information so that they can take up the suggested solutions to the problems they have incurred. It It helps in adjusting the economic environment of the business by overcoming the seasonal and cyclical fluctuations. You know, with the economic booms and the recessions, whereby there is a time when the company is producing everything at a very nice cost, low cost. It is having a lot of profits, but there is also a time when the company is incurring most costs, and of course, when you're incurring more costs, you expect to be getting less profits. So management accountants, since it is a broad aspect, it looks into everything and tries to control those so that we can be having an optimal or a balanced movement within the production process or within the operations of the business. That's another role of management accountant, because for them, they look at when the company is producing less, what should we do to boost the company? If the company is producing more and we are getting more profit, or we are getting whatever we are getting, how are we minimizing that to what we want? That's the role of management accountant. We can talk about it helps in measuring the performance of business and evaluating the capital investments in various projects. That one I talked about it, but as we've said, you can measure even the performance of the accountant, because when the management accountant goes through the work of those two, the cost and the financial accountant, and they find out that the information, they have different information, because when the cost accountant prepares the information, the cost accountant gives the information to the financial accountant so that they can prepare the receipt. It's like when they give you the production cost, you can add it to the other side of the trading account in the profit and loss. You start to generate the income statement. So if these two, they are not doing well in whatever they are presenting, the management accountant can find out or evaluate how they do. So even on the side of the capital investment, there the management accountants, of course, they compare according to what to what the cost accountant has given the cost, the financial accountant what he or she has given as in the profit, then they compare the viability, because at the end of the day, those are the final decision makers. And the major point you shouldn't forget is that management accounting is all about making decisions. Then allow me look at the limitations of management accounting. And in this, I want you to appreciate, I brought this limitation to the extent that I wanted you to appreciate these two aspects, and you try to get to know the advantage, their scope, as in how far do they go within as far as decision making is concerned, and what can be the problem to that. So let's look at the limitations of management accountant or a management accounting. Management accounting, to a large extent, is based on estimates and probabilities. Thus, accuracy may not be ensured under management accounting. Reason, because what we base on, we are all using, the method is they use budgetary control systems, standard costing, whereby they're just using estimates, not exact figures. So if they are using estimates, there is a high chance that what they have expected, it will not happen. Reason, there are some things which they have no control, and for them they are assumed that maybe they will remain constant, and you find that they are not constant, they keep changing. So that becomes a challenge to the management accountant. Whatever information they don't have like the information of their own, they get the information they got from other people. So to the extent, since they base on estimates and probabilities, thus accuracy is not ensured. It is only a tool in hands of management and cannot replace excuse me, and cannot replace management. It's supposed to be and cannot replace management. Why? This cost accounting, this management system is just a system. If let's say this system, for it gives you the correct and accurate information based on the information you have provided. But that system doesn't necessarily replace the people within the management. Yes, the system is there, it is giving you the rightful information, but you may find what is really these people, because at the end of the day, if it gives you this information, it's the system that it generates what the management accountant has provided to the system. So you may say that yes, it is a system, it does everything perfectly, but it does not replace people. So it is a limitation to the extent that if the management accountant feeds a wrong information to the system, it will give a different information, of which it may be either misleading or depending on whatever the organization wants to achieve. So that's also a limitation. We talk about the management accounting derives information from financial accounting, cost accounts, and other records. Therefore, its strengths and weaknesses depend upon the strengths and weaknesses of these basic records. That's also a challenge, whereby since these management accountants, for them, they don't generate the information of their own. They can be given doctored statements and other information depending on whatever they wanted to get from the cost accountant, the management accountant. And from there, they will be misguided and they get a wrong, or they make wrong decisions. So the successfulness of a management accountant is based on the success of those two, the management accountant, and if you get one of them is not okay, then you expect that somehow, somewhere, you may find there are some mistakes which may lead even to making different and costly decisions, because some decisions, like the capital investment decisions, they are irreversible, or they can be reversed at a very high rate. It's like if, let's say, you commit that I'm going to set up a sugar making factory. If a sugar making factory was one of the business ideas we were verifying, trying to find their viability, and you find that you've incurred the money in purchasing those items which are used in production of that, let's say, sugar, and you find that the business is not or you were misguided, you got the information, you got a wrong information from the cost of financial accountant, and you cannot reverse. Even if you want to reverse, a machine which is used to manufacture sugar, you can't convert it to a machine that can make soda. They are different, and you've incurred thousands and thousands of money. So that's a challenge in that, whereby the strength of the management accounts are as good as the strength of the financial and the cost accounts. Then the other limitation, it is costly to install and only big businesses can afford. It is hard, like for companies, it is hard for a small company to be having a financial accountant, a tax accountant, to be having a cost accountant, and at the same time be having a management accounting. Having all those people, it is a cost. So these other companies, they end up having only one person, like that they have a financial accountant who handles everything in tax, in cost, in management, and everything. So you find it is only one person, but he or she has been overloaded with so many things, just because the company cannot afford to recruit all those people who can, all those experts who can handle everything on time. So the last one I'm going to talk about, it involves various disciplines like tax, statistics, finance, mathematics. You can add everything, cost. So without those various skills or knowledge, then it's hard to find solutions, because it's also hard and it is very expensive for someone to acquire a person who has a bias in all those aspects which are within the management. Because at the end of the day, we expect the management accountant to make a decision after considering all the costs, not saying that, we've incurred less costs on this item, so let's go ahead and invest in the money. You may be incurring less cost, but at the expense of other people, or you are not considering, let's say, the public interest or the environment aspect. So all that is supposed to be included within the report that the management accountant does. So allow me proceed to the next one, and I want to talk about the relationship between the cost accounting and the management accounting. There are minor differences between management accounting and costing accounting, since the former, which is the management accounting, is an extension of the latter, meaning management accounting is an extension of the cost accounting. They are closely linked as they use common basic data and reports to a significant level, because we said the cost accountant stops at the point when he or she finds the cost of production. But for the management accountant, goes ahead to the point of determining the selling price. So the cost accountant is to the significant level of cost determination. Then the other one to the maximum level of selling price determination. In accounting, primary emphasis is on cost. In cost accounting, primary emphasis is on cost ascertainment and control, while management accounting utilizes the principles and practice of financial accounting and cost accounting, in addition to other management techniques for efficient operation of the company, e.g. statistics, mathematics, economics, laws, etc. So I think you've got the relationship between those two. This cost accounting, it's, you can call it, process-wise, you can call it that the cost accounting is an input to the management accounting, because what the cost accountant does becomes the output of the cost accountant becomes the input of the management accountant as far as their duties are concerned. So allow me proceed to the next slide, where I'm going to be talking about, since we've known the relationship between the cost and management accountant, then we can combine them. And since we've seen there are few differences between the management and the cost accountant. So we are going to combine the cost and management accounting. We compare it with the financial accounting, at least the financial accounting and these two, they have a very big difference in terms of the way they are prepared, in terms of the number of users, in terms of the documents they prepare, and in terms of the period of preparation of those statements, in terms of the legal requirement, in terms of so many things, as we are going to see. Financial accounting, then the cost accounting, the cost and management accounting, because under cost accounting, stock is valued at cost only. But in financial accounting, we may find we are not only computing the cost, because when you remember when you are trying to determine the financial statements, we consider the cost and we also consider the price, because we have to determine the sales, of which the sales will get the units sold times the selling price to get the sales. And to get the cost of sales, we use the costs. So we use the costs we got from the cost accountant to determine the cost of production. There is a difference. Here in stock, stock is valued at cost or market price. But the other side, stock is valued at cost only. Why? Because we are producing our own goods. We are not buying them from the suppliers. In financial accounting, financial statements are reported in a specific formats. So that different organizations can compare. Like in financial accounting statements, we have a format, how we prepare, like format for companies. We have the format, how we prepare, how it's supposed to be looking like. And it's a requirement by government to prepare those statements in that format, which is not the case with the cost and management accounting, because with the cost and management accounts, we just use them within the organization. They are not published outside. That's why we can use any format we want, which is not the case with the financial accounting statements. Under financial accounting, the information is used by both internal and external users, whereby we can give it to customer, we can give it to shareholders, we can give it to even the employees, the general public, the government. But this cost accounting information, they are used internally by internal users. The employees can view it, but most of the times it's used by the management and the shareholders. Sometimes even the shareholders can try to have a look, but most of the times it's used by the management accounting, just to run the day-to-day running of the business, the operations of the business. Then we can talk about the legal requirement. Financial accounting statements, they are required by law, which is not the same way like for the cost and management accounts. Management accounts, you just prepare them as and when they are needed. It's not but for the financial accountant, for the financial accounting statements, you have to prepare them every year and they're supposed to be published. Under financial accounting, the focus is on historical information. We said as per the historical concept in financial accounting, we said we base on the cost of the item. The purchase price of the item becomes the cost of the item forever. If you bought, let's say, an item of 10, let's say 10 million, and next day the price goes to 12 million, we only consider the 10 million as the historical costs. And those are the ones we put in our statements. But for these management accountants and cost accountants accounts, for them, since we are preparing future, we are making forecasts, we are making estimates, we are making predictions, we just base on the future costs or the present value, the present costs. Because if you want to know the deviation or the variation between the prices of different commodities, you will have to use the current price and maybe the future. You predict the future or what was there as the base period prices. Then the last one, we can talk about the disclosure. In financial accounting discloses financial information and the positions of the company. What we are looking at when you are preparing financial statements is that we want to know the profitability of the company and how the company stands, or the net worth of the company. Then for these management accounts, for us, we want to know the information so that we can give it to management and we make a decision, and that's all. So those are the differences between financial accounting and cost and management accounting. But don't forget that when this information, anyway, I'm going to talk about it when I got the users. The next thing is the users of accounting information. I was saying the accounting information, before we talk about the users of the accounting information, there's something I want you guys to take note of. Because sometimes you may find that this thing will be a bit of help when you find, let's say, some scenario question, to the extent, because they may ask that this information, what will be the quality? What are the qualities of this accounting information? I did not make a slide about it, but I can talk about it briefly. Because this accounting information, we need to know the quality we are giving before knowing the people who are going to use. But these are the ethics we can, or the characteristics of the accounting information. We should provide that accounting information on time. Meaning the first characteristics is, or the quality is, time or timeliness. We should provide that information as and to when it is needed. Let someone, not giving someone something, someone is asking for a financial statement of this year, you give the person after 3 years. It doesn't make sense. The information is supposed to be timely. The other one should be complete. You should be having everything. It should be complete. It should be relevant. I'm asking you financial statements of this year, you are giving me financial statement of 2 years, or you're just giving me a different statement. And there are so many others, the completeness, concise and precise. You can talk about them, but they are hard to be set at this level, but I want you at least to get a highlight about them. So we go to the users of accounting information. When you're defining these users of the accounting information, make sure don't stop at the user, him or herself, but go ahead and find out what that person wants for the statements they're asking. I'm repeating, these users of this accounting information, we are not interested in the users themselves. We are interested in what do they want when they say want to see this. Let's say want to see the financial statements. What do you want to see? That's exactly the point. So these accounting users, we have the owners and investors. I'm just going to give you like 4. The rest you can look for the information and you add there. Owners and the shareholders, stock the investors, stakeholders of corporations need financial information to help them make decision on what to do with their investment, either to sell or hold. The business. The business owners use the information to determine if the business is profitable or not. As we said, for these stakeholders, these are the people who provide money to the business, or the people who lend money to the business in the form of buying shares. So for them, they want to know if the company can sustain them by providing them dividends on their investments, or the company cannot provide their dividends, so they make the decision whether to quit or to stay in the business. These business owners, we said business owners, they are the ones giving money to, or the owners of the business. They are the ones giving money to the business. So for them, they want to know, is this company really making profits or it doesn't make profits? So that they also make a decision whether to sell the company or to change into another line of business. The other one, we can talk about the management. Management, as we said, whenever we talk about the management, just know we are talking about the decision makers. So whenever we talk about the management as the users of accounting information, what really do they want? They want information to help them make decisions on the day-to-day operations of business. The third thing, we can talk about the financial institutions or lenders or banks. These are the people who give businesses credit facilities or credit assistance. What do they want in this financial statement? They want to know our credit worthiness. Are we making profits that we can be able to pay them, or we are not making profits, we are just making losses? The other one, we can talk about the government. The government, especially the tax authorities, for them what they want is whether the company can be able to pay the tax in time and an appropriate amount. The other one, we can talk about the customer. Those are the people who buy goods on who buy our goods. So they want to know whether we can give them goods on a low price, or we can be able to give them discounts and others. We can talk about even the general public, where the general surrounding of the business, where the business is operating. Are you not polluting the environment? Are you giving them corporate social responsibilities and others? We can talk about the employees and creditors. Employees, for them, they are interested whether the company is making profits so that they are sure of the job security and the company is able of paying them the money, their salaries in time and in the rightful amount. Allow me proceed to the next slide and talk about the ethical requirements of management accountants. And this is where I'm going to stop. When I wind up this ethical requirements, that's where I will stop for today. And as we discussed in the beginning, the ethical requirements we are talking about, these management accountants, first of all, they have the professional bodies that govern them, how they do their activities. Or these are like the responsibilities, the way how they do their job, the do's and don'ts set by their professional bodies which are governing them in their way of operation. What they should be following when they are executing their duties. One of them will have competence. Competence, we are saying, maintain an appropriate level of professional competence by ongoing development of their knowledge and skills. We can talk about it in performance, or perform their duties in accordance with relevant laws, regulations, and technical standards, or prepare complete and clear reports and recommendation after appropriate analysis of relevant and reliable information. So that's what we expect from them. We expect when they are doing their duties, when they are executing, or when they are making decisions, they must be professional. It's better you call a spade, not calling a spade a spoon. That's when the company is making losses, say it that the company is, for this financial year, it has made a loss of this amount. Not again doctoring the information and you start giving the information the other way around, just because you have some interests you are saving, or the personal interest you are providing out. And when you're giving out that information, there are certain laws. You are not supposed to do this. So are you really up to that extent, then are you giving the recommendation as exactly as they are supposed to be given? If, let's say, the company is making a loss, or you have reviewed the, let's say, the cash budgets, and you are seeing in, let's say, certain months, we are operating in negatives. And to the extent that if you forecast that we are going to be having negatives, there is no operation which can be negative. So you have to give a recommendation, and that recommendation, you should not just give a recommendation. Let's say we acquire some money which can finance our operations for those periods. You should also assess the way are we supposed to get the money. Is it by loan? If we get a loan, is it of a help, or it will add another burden to us? So you look through everything and you make a final decision which is reliable. That's what they mean by competence. The second one, because there are only 4. The second one is confidentiality. Inform subordinates as appropriate regarding the confidentiality of information acquired in the course of their actions, and monitor their activities to acquire the maintenance of that confidentiality. You are not supposed to issue information to any person who is not entitled to that information. Are you doing it? If, let's say, this information is not supposed to be given to the public before the top management views or review everything, are you not giving it out on your own benefit? So those are the things. Are you making the information you are getting to be that someone can trust you with whatever information they have authorized you to handle? That's what they are talking about when they say the confidentiality. The third one, we can talk about the credibility. Credibility, we can talk about it in terms of communicate information fairly and objectively. You communicate the information, but the information is as per what you want to achieve. The fourth one is integrity. Integrity, we can talk about it in avoid actual or apparent conflict of interest and advise all appropriate parties of any potential conflict. Refuse any gift, favor that would influence their actions. Because when you are making certain judgments, you may find that instead of saying that we are making losses as per the financial statement, but because you want to save you have to save certain people, or someone has told you to report this and this and this, then you go out there and you start giving a wrong information just because you have interest, or someone has given you something to say something about, which is not exactly the truth. So I will leave you to research about the resolutions of ethical conflicts. These ethical conflicts, those are the ethical conflicts. They result as a result of the absence of the ethical requirements. If someone is not capable of doing the information in a rightful way, then you just know there is ethical conflict, whereby the person cannot give a fair view of whatever he or she is reporting because someone wants to bribe. You cannot keep the information. Someone wants the information from you and is bribing you or threatening you to give the information by force. Those are the ethical issues. Then how do we resolve them? That's what I want you guys to go and search about. Because when you're resolving, like if someone is giving you a bribe, what do? You can report to the supervisor. Maybe if the supervisor is also involved. Then if the supervisor is involved, you don't. Because you can't report someone who is also threatening you to a certain level. But if you try all other ways of how you can resolve the conflict and you see it cannot end. Because the reason why these ethical conflicts they come in is that their results or your actions may be, because when you perform something, if let's say you are the head of a department and you are threatened to sign some documents which you don't even understand, which you have not read through, any circumstance or any result that may come out of that action is held to you as the person who authorized certain transactions. So if you try to see and things are not coming, the last resolution is just quitting. You just leave the job. Because at the end of the day, it's you. If you authorize something and you are not sure of what you are authorizing, then any result, which whether bad or good, will be upon you, because you are the one authorizing some certain decisions. And that's all for today. Allow me stop here. And I hope, guys, you've benefited a lot. And I kindly asking you to subscribe and keep following the channel, because I'm going to be dropping more videos, and I hope you'll be able to learn more and more from my channel. Thank you so much, and God bless you.